NIO stock is once again in the spotlight ahead of its upcoming Q1 earnings report. The company is showing massive revenue growth, strong vehicle deliveries, and improving margins. So why is the stock still falling? In today's video, we'll break down the latest NIO earnings preview, why Wall Street remains bullish, what investors are expecting from Q1, and whether this recent stock decline could actually be a buying opportunity. Let's get started. Chart increasing Part 1. Why NIO stock is moving. NIO shares have been under pressure recently despite several positive developments from the company. The Chinese EV maker is expected to report first quarter earnings this Thursday, and investors are paying very close attention to margins, delivery growth, and profitability progress. Wall Street currently expects NIO to report earnings per share of -12 cents and revenue around $3.7 billion. That revenue number would represent more than 100% growth compared to the same quarter last year. And that is one of the biggest reasons many analysts remain optimistic on the stock. Automobile Part 2. Strong delivery growth. NIO recently announced that it delivered more than 29,000 vehicles in April 2026. That's a year-over-year increase of nearly 23%. Even more importantly, cumulative deliveries have now crossed 1.11 million vehicles. This shows that demand for NIO vehicles is still growing despite intense competition in the EV market. The company is also benefiting from newer vehicle models, improved product mix, and expansion of its battery swap ecosystem. These factors are helping NIO improve its overall business quality. Bar chart Part 3. Analysts are bullish. One major Wall Street firm, Citi, continues to rate NIO as a buy with a price target of $7.60. Analyst Jeff Chung believes NIO's gross profit margins could improve further during the second quarter thanks to better product mix and cost optimization. Some analysts also believe NIO could soon return to positive non-GAAP profitability levels. That would be a very important milestone for the company because profitability has remained one of the biggest concerns for investors. Meanwhile, several analysts expect strong full-year 2026 delivery growth between 40 and 50%. Warning Part 4. So why is the stock falling? Despite all these positive numbers, NIO stock has recently declined. And there are several reasons for that. First, investors remain cautious about the broader Chinese economy and EV market competition. Companies like Tesla, BYD, Xpeng, and Li Auto continue to put pressure on pricing and margins across the industry. Second, some investors may simply be taking profits ahead of earnings because earnings reports often create volatility. And finally, many traders still want stronger proof that NIO can maintain long-term profitability. So even though growth remains impressive, market sentiment is still mixed. Fire Part 5. Could this be a buying opportunity? Some investors believe the current weakness in NIO stock could actually represent an opportunity. The company is showing improving revenue growth, rising deliveries, expanding services, and better operational efficiency. If upcoming earnings surprise positively and margins continue improving, investor sentiment could quickly shift. However, risks still remain, especially regarding competition and profitability consistency. So the next earnings report could become a major moment for the stock.